Okay, we're continuing with chapter 5. Last video we talked about purchasing and buying. I stressed that this chapter has both buying and selling transactions, so you always got to make sure which side you're on in this case. So we just got done through being the buyer. We were purchasing things as a merchandising business, and now we're going to talk about being the seller, so selling items as a merchandising business. So a merchandising business, like we said, buys things from other people and then resells them to others. So they have kind of two pieces to their sales when they make a sale. The first piece is the revenue side. So the first example that it gives in the book, it says that Net Solutions sells merchandise for $1,800 in cash. So if that were the case, we receive cash of $1,800, so we debit cash, increase cash by $1,800, and we credit sales. Sales, remember, is that new revenue account. It is just a revenue account. We had fees earned before, which have a little bit different name because we're a merchandising business now. But we're not done, because when I sell something in a merchandising business, I'm selling an actual physical item that I owned prior to this, which means I need to also show that I no longer own this item. So I need to get rid of it from my inventory. Well, inventory is an asset, so I'm going to credit inventory. I'm going to credit the inventory account, but it has to tell me. In future chapters, we'll do the math ourselves, but for these chapters, we're going to tell you how much that inventory costs you. In the book, this one says that the cost of goods sold, so how much that inventory cost me, was $1,200. So I'm going to credit inventory for $1,200. The other part of this, because my debits must equal my credits, is cost of goods sold, $1,200. So that would be a cash sale. If I made a sale of $1,800, and the cost of goods sold was $1,200. So every time I have a sales transaction, whether it's a cash or on account or any of those things, it's always going to be two parts to it. I'm going to have what I refer to as the revenue side, the money actually coming in, and this could be accounts receivable. If this is on account instead, this would be account receivable. It was cash for this example, but this could be accounts receivable. And then the expense side, or the asset side, that I'm getting rid of, where this shows how much I spent on the inventory that I just sold. Okay. So the other thing about this is that we have customer discounts, just like we had discounts for purchasing from the prior chapter. So we need to make sure to take those into account if it is offered. So we have one on the next page of the chapter. It says that we recorded a sale on account for $18,000 and my cost of goods sold was $10,800. Rather than reinventing the wheel and retyping here, I'm just going to do $18,000 was my sales, and my cost of goods sold for this one was $10,800 and $10,800. But I also had terms, and I'm just typing this out the slide so you can see it. And these terms, good news, work the same way the purchase ones do as far as like the nomenclature or how we name them. But realize that we're the seller now, so we're offering the discount. We're not taking the discount. Taking the discount when we're the purchaser, we're offering someone else to take a discount when we're the seller. So the terms on this one, according to the book, are 2, 10, and 30. And if you watched the last video and understood what that means that I am offering a 2% discount if we get paid within 10 days. If they don't pay us within 10 days, they owe us the full amount in 30 days. So if they do take the discount when we actually get paid, then we would record the fact that that they took that discount. Now, there's two methods to do this, and the book has a preferred method. If I'm offering a discount, the way that the book usually does it, and the way that I would say most firms do it, if they make the assumption, if most of their customers take discounts, and this is the method that we would use, generally the discounts are utilized by their customers. So if I'm offering a 2% discount, that's $18,000 times 2%, which is $360. So I can take $18,000 minus $360, and when I record it in the first place, that's how I would record it. I would record it less the discount amount. Now, when that happens, there's two things that can occur. Either they can pay us the discounted amount, if that happens, so let's make the assumption they paid within the discount period, which means they took the discount. They paid within the discount period, they paid us, so we received cash, $17,640, because why would they pay them within the discount period if they weren't going to take the discount? And we would credit accounts receivable for $17,640. Okay, that would be if they paid within the discount period. If I recorded it this way and they paid within the discount period. So this is one example. Okay, paying within the discount period. What happens if they don't? So this same problem, all else being the same, what happens if they don't pay us within the discount period? Well, in that case, they're going to pay us more than $17,640. I'm going to receive the full $18,000, our original number for cash. Accounts receivable, I can only still credit it for the $17,640 because that's all that I'm showing that I am owed. But I can't be done here because I do not balance. Instead, since my sales were underbooked by $360, I need to record the revenue for the rest of it to $360, and I should balance. Total of these two should be $18,000. That is, and the cash amount is $18,000. So that would be a sale, sale on account with credit terms. So let's do one more example of this before we move on. So I'm going to hide this. All right. So now let's do this one. Journalize the following. We sold merchandise on account. Okay, sold merchandise on account. Terms 1/10/30. And our amount that we sold it for was $92.05, and the cost of goods sold was $55. So we'd want to record this assuming they were going to take the discount. So I'd take $92,500, take that times 1%, which is $925. So I would debit my accounts receivable for $92,500 minus the discount. And I would credit my sales for the same amount. And then remember, for a sales transaction, we always have two parts to it. I also need to record the cost of goods sold. Discounts don't affect the cost of goods sold. Cost of goods is exactly what it sounds like, how much it costs me, so it can't be affected by a discount. Oops, $55,000. And so that's an increase on my expense account, the cost of goods sold. And then I would credit inventory. $55,000 to show that I no longer have that inventory. So that's part one. So this whole thing here is just part one of this question. Sold merchandise on account. So now we can move on to part two, where we receive the payment less the discount. So they did pay within the discount period. So paid within the discount period. And so if I receive the payment, I'm going to receive cash. Since they paid within the discount period, they're only going to pay me $91,575, and then I'm going to credit accounts receivable to reduce accounts receivable by the same amount, $91,575. And that is all for sales transactions. Next video should be on freight and how that works. Who's responsible for freight, who has to pay it, and how to re-record that on our books.